Launch into our presentation tonight in just the next few minutes as a few more folks join us. Thank you to all. Some of the early birds have heard this a time or two, but thank you so much for being here. I'm excited to talk with you about mortgage note investing tonight. I absolutely love the topic. We're going to talk about how performing and non-performing notes compare. So I'll be bouncing over into that PowerPoint presentation in just a moment. We're also going to go through information, just some very basic and general information about the note industry to set the table, as it were, to explain what we're doing, why we're involved, why we think this is an amazing opportunity for specifically self-directed IRA investors. We'll go through and detail that. So let me go ahead and invite you. If you haven't done this yet, I see most people have. If you'll go through and mute, I will allow for ample opportunity for you to come back and ask questions at the end. But let me switch over to the PowerPoint presentation and we shall begin. Let's move over here. All right. So again, thank you all very, very much for taking the time. I greatly appreciate it. I'm honored that you took the time to spend time with me this evening or afternoon, wherever it is you're at. Again, my name is Jerry Wallace. I'm with FiveWB LLC, Mortgage Note Investing. This presentation is going to focus on performing versus non-performing real estate notes. Let's talk about the pros, the cons, and what we can do with each one of them. Now, before we jump into that, I do need to do just a little bit of housekeeping. I need to tell you that, folks, I am not a financial planner, not a CPA. I'm sure you know how the rest of this disclaimer goes. This whole topic involves risks. Any actions taken based on this information are at your own risk. So I have to tell you that. I'm sure that you realize that, but always consider your own financial situation, risk tolerance, and investment goals before jumping into any investment decisions. So with that all out of the way, let me just welcome you again, tell you I really appreciate you joining us. Let me tell you a little bit about who I am, why I'm sitting here talking to you about this. I'm the managing member of FiveWB LLC. I began investing in real estate in 2001. I've got a master's degree in public administration, been in business management for 20 years, have 5 amazing boys. My second oldest, I'm going to go see graduate as soon as this wraps up. So pretty excited about that. Just wanted to give you a little bit of background on who it is that's talking to you about these note investments. Welcome to our webinar. As I mentioned, we're going to explore the pros and cons of performing and non-performing note investment. What we're going to cover today, folks, is going to be an introduction to note investing. We'll touch on the comparisons of performing versus non-performing. We're going to talk about suitability based on an individual investor's risk tolerance and some final tips and takeaways. So what is real estate note investing? I know that some of you are quite involved and know what that means. Others on the call don't. A real estate note is simply a promissory note that is secured by real estate. FiveWB we purchase real estate notes to invest like a bank does so that we can collect the monthly payments and earn a good, well-secured return. That's what we're all about. So as we move into our focus topic for tonight, performing versus non-performing notes, let's talk about how each type of note works and what are the pros and cons of each. Performing notes, of course, the pros are consistent cash flow. You've got that monthly flow coming in typically between the 1st and 5th of each month. Lower risk, definitely a pro. Higher liquidity, you can sell these easier should you have a need to. The cons are lower returns, and there's just more people in the market for this type of product, folks, for the performing notes. They're fairly straightforward and pretty easy to manage. Non-performing notes, on the other hand, provide higher returns, right? Lower purchase price, definitely a pro. Opportunity for asset acquisition. You can actually end up picking up the property, which some people target, right? The cons, of course, higher risk, uncertain cash flow. No real way to know exactly when you're going to cash out, exactly what time with one of these transactions. And there are potential legal challenges. Let's just be very transparent about this. Non-performing loans, non-performing notes certainly carry a higher incident of foreclosure, which can not only be very costly, but time consuming. So that's the legal challenges being referenced. What I'm going to do, folks, is I'm going to take you through two different case studies to illustrate for you what each one of these opportunities can look like before we begin to work toward the goal of deciding which option might be best for you. So the performing note case study that I've prepared for tonight is on a property that we worked with at a $258,000 fair market value, as you can see here. And just to break it down, this property had a $235,400 note being sold at a significant discount of $188,320. So that's a $47,000 and change discount, very substantial, bringing us to a 73% investment to value. So this was a great transaction to perform the case study on. The deal analysis is that this note had an 8.2% interest rate. Again, as I mentioned, significant discount. This resulted in a 10.94% yield. Very solid investment to value. Now, the exit plan. Let's talk about what we do with the majority of these performing notes, right? The goal for all of them is to hold long-term, right? And enjoy an above average yield with a well-secured real estate backed note. This one, for example, had 346 months left on it. So that's our case study to illustrate for you what a performing note can look like with FiveWB. Now, for the non-performing case study, if you would, please, I'm sorry, please mute yourself. The non-performing note case study we will go through and look at for today. And this one's going to take a good bit more of our time because, frankly, non-performing notes take much more time to manage, right? We're going to talk about the potential outcomes in much greater detail with the non-performing notes. In this case study, we have a property with a $165,000 market value, a $140,250 note being sold for $74,322. That's a very significant discount of almost $66,000. That brought us to a 45% investment value. The deal analysis with this particular non-performing note is that it is an 8.5% interest rate, monthly payments at $1,277. Now, I listed that on this and not the previous case study because that'll be relevant on the next slide. Has 213 months left on the mortgage. No payments have been made for 7 months, right? That's critical to understand about the purchase of any non-performing note. But in this case study, no payments have been received for 7 months when we got involved in this picture and began to analyze it. What I really want to focus on for the rest of this case study, if you don't already know this, is what the three possible outcomes are. What could possibly happen with one of these non-performing notes, okay? Loan modification, we're going to talk about all three of these in some detail, which makes up about 50% of our annualized deal flow. Cash for keys or deed in lieu of foreclosure makes up about 25%. And the balance, the last 25%, is roughly going to be in that foreclosure column. So let's go through and talk about these. Again, the three possible outcomes with non-performing notes, as you see reading from left to right, there are loan modification. You see the image there with the cash being traded for the keys. We'll talk about that. And then straight up foreclosure. I'm sorry, I don't mean to be rude. If you would, please mute yourself. So let's talk about loan modification. What does this first option look like, folks, when we're comparing these two options? Loan modification in this particular case study resulted in reinstatement and 6 months of payment, and adding those two together generated the reinstatement and the 6 months of payments generated $12,775, folks. And the note being sold after being held for 12 months at roughly 85% of the note's face. And that meant that brought $119,212 in, okay? We subtract out the purchase price. This generated a $57,655 total profit. So very, very strong profit ratios there. What does the cash for keys, the option number 2 or exit number 2, look like? This is very different, okay? And as we go from left to right, if you're not familiar with these options, you'll notice that we get more involved the further we go from left to right, okay? Loan modifications, which that's our goal. Let me just go ahead and tell you that. That's FiveWB's goal with every transaction, is to keep the borrower in the property as long as it is possible for them and it is good for them and we can make it happen. We're always going to make that the goal. Exit plan number 2 with the Cash for Keys program very simply represents, folks, a situation where a borrower does not have the means to hang on to that property. It just can't happen. We would be doing them a disservice trying to make that happen for them. They just don't have the revenue to make that happen. And what we've chosen to do in this scenario is offer the person some cash, some funding to help them get moved, get restarted in a very, self-respecting way so that they can move on with life. The numbers in this exit plan are selling at 90% of the fair market value, $148,500 less $5,000, which goes to the borrower. That is the cash that we're trading for the keys and their cooperation. Estimated in about $8,910 for marketing and closing costs. This generated $60,258 revenue. Now, timelines in these last 2, folks, they become absolutely critical. Now, these can vary somewhat. These are not exact, but these are estimates. This could take between 6 months and a year, okay, to execute this plan. This last option that we're going to talk about, foreclosure, is literally not only the last option in my presentation, but it's the last thing we want to see happen. We don't have the desire to foreclose on anyone, but there are folks that we purchase loans and they're going to bury their head in the sand. They're not willing to do any type of loan modification, won't talk about cash for keys and or back out of those.
Okay.
And you have to foreclose.
Okay, cool. So we'll just wait
So
on that.
I'm sorry.
All right, so now we can talk about the QBR.
I'm sorry. Please
Let
mute.
me show you the slides. Share screen. Oh, let me.
Okay, thank you. Sorry about that. Isn't Zoom fun, folks? You just never know what's going to happen, right? So what happens in the last option in exit plan number 3 is the foreclosure. And you'll notice the timeline is really the big difference, right? We sell at 90% of the fair market value, $148,500. The difference here, as you can see between exit plan 2 and 3, is that $5K now is going to who? The attorneys make all the money in foreclosure, right? We would much rather see the borrower receive that money and get a fresh start, but some people put us in that box. It has to happen from time to time. The same $89.10 to market with, it's really the same closing cost, typically $60,258 being the revenue generated from the sale. But you see that we estimate it could take between 1 and 2 years now, right? What's the difference? Why? Well, it can take a long time to foreclose, folks, and we're just very real about that. And of course, that varies greatly depending upon what state you are in. So we focus on states that are lender friendly, right? We think they're much fairer. That does not mean that we have no-go states. We will look at a potential transaction anywhere, but there are certainly states that we're going to favor. And no surprise, they're going to be those that help move through that process more quickly when necessary. So which one of these note investing options works best for you? It really has a lot to do with your risk tolerance and what your desired outcomes are. What are you expecting out of these investments, right? Performing notes offer a lower risk and a much more consistent cash flow. You're getting that payment in every month. Non-performing notes provide considerably higher potential returns and asset acquisition opportunities, which can dramatically improve the profits as well. So in my opinion, real estate note investing is hands down the best way to invest in real estate. Why? It's because you can enjoy an above average return on investment while, and this is critical, folks, in my opinion, while avoiding the pitfalls that come with being a landlord or rehabbing properties. Now, let me tell you, I mentioned I've been working around real estate going back to 2001. I've done a lot of this. I've done a lot of rehabbing. I've done a lot of landlording. Nothing wrong with it. It's a great business. This is not the business I want to be in at this point in my life. And I'm telling you that this is a far, far better investment, in my humble but accurate opinion. Note investing keeps you out of dealing with tenants, toilets, taxes, at least not that you pay directly. Note investors have property owners paying them monthly, right? Right? Not renters, property owners. And property owners pay their own property taxes and handle that daggone property maintenance. That's a beautiful thing. If you've ever been a landlord, you know exactly what I'm talking about. So let me just address one other really important thing. Who handles all of this? What professionals are involved in taking care of these transactions with FiveWB? These professional loan servicing, insurance, title service, and legal advisement professionals are the ones that enable us to work in many, many states across the country, right? And keep us well secured. And when and if we do ever have, unfortunately, a foreclosure to deal with, they dive in and provide those professional services to make sure it is done appropriately, legally, and properly. So be glad to give you more information about that, about the team of professionals that works with us. It's very important to know who that is with any potential investment. But let me run through a few final tips and takeaways, and then we will answer questions and then see what Ms. Hall has for us to inform us about her self-directed IRA services. I want to tell you that the decision to invest in performing or non-performing notes, it obviously depends on each investor's investment goals and risk tolerance. I invite you to continue this conversation. There's so many people on the call right now. We had over 106 people that had inquired about this along the way. So many different people that wanted to know more about this. And I will just simply have to tell you that my next best step is to have a one-on-one with you. If you'd like to do that, I invite you to continue that conversation to find out how note investing can work for you and really whether performing or non-performing notes is the best vehicle to achieve your goals. So the way that we can do that is we can go through and you can choose the best option for you. You're welcome to call me at 888-922-0788. Email, you can book a call, which I absolutely love. People find that very convenient at FiveWB.com. And I'm going to show you that website and exactly where to do that in just a moment. There's information about our LinkedIn, information about our free investor report at FiveWB as well. Let me bounce over here and show you the site. And this is exactly where you would go to FiveWB.com to schedule a Zoom call with me. So if you see this Work With Me tab at the top, if you're at all interested in, as I said, continuing our conversation, which I invite you to do, you can click on this now or after the webinar concludes in a few minutes. Click on that Work With Me button and it will give you, as I'm going to show you here, the option to go through and schedule a Zoom meeting with me at your convenience. So I want to thank you very, very much for taking the time to talk with me. It has been an absolute pleasure to speak with you. I am going to turn the conversation over to Ms. Hall for just a moment, who I greatly thank for being available to talk to us about her self-directed IRA services, and she will wrap us up for the evening. Last thing I want to make sure you all know is that you will tomorrow each receive a link to this recorded webinar for your review. And I look forward to speaking to each one of you. I encourage you to schedule a time to talk in the next week or so. Thank you so much for your time. Ms. Hall, I am making you the host, and away we go.
Oh, thank you, Jerry. I really appreciate it. And so I will go ahead and share my presentation. Jerry's right, because self-directed IRAs really are a great vehicle for retirement, but they're also a great vehicle for note investing as well. And notes are, I'd say, the #2 most popular asset in self-directed IRAs in general. So let's go over a few things, and I'll also open things for questions, open the chat for questions. But self-directing your IRA is the best way, I think, to plan for your future, because you're not stuck with Wall Street investments, as Jerry was explaining to us. You can invest outside of Wall Street in assets like real estate, all of its versions, and that includes note investing, secured and unsecured debt, so many different other things too, even cryptocurrency and precious metals, and gosh, just a litany of things. So we'll cover that right now. So let's see here. All right, a little bit about me. My background is I come from really the real estate background. I've been a property manager, a realtor for 1 year in my 20s. I did that. And, God bless the people who do, because it's tough. Mortgage loan servicing, I was in that for a long time, and loan origination, and learned so much about real estate from really from these areas, because getting a real estate license, you take a class, you learn a lot about, then you go out and do it, and then you invest yourself, and it's just the best education, hands-on. And I was a loan originator for a number of years, and then moved over into the self-directed IRA space. By the way, I did some property management I didn't mention. But in 2007, I jumped over into self-directed IRAs. And by 2009, I opened UDirect IRA Services. And that was about the time that I joined RITA, the Retirement Industry Trust Association. And we're like a lobby based out of Florida, but we meet annually in DC and once in the West someplace. We meet twice a year. And we talk about ways to improve our industry as a whole. Things like, well, my thing is fraud awareness, to talk about fraud awareness and just to talk about the various challenges our industry has so that we can discuss them as a group. And I have a couple industry certifications, but before I did all of this, I was a radio announcer. And so that gave me a little background into public speaking. And all of these things have led into what UDirect IRA Services is today, at least my background. So when I hire people at UDirect, I always hire people with real estate background so that they understand notes. If somebody wants an allonge, they don't have to say, I have no idea what that is. We just run with it, no problem. And that everyone who works here understands all of the, all the nomenclature and can just give you the best possible service. So when you are investing, you are with your retirement account, you're in this amazing group of investors, make that $40 trillion in retirement, about 14, but now it's 16 in IRA money. That number goes up annually. About 12 trillion in solo Ks. And you can see from the slide where all this money is, but wow, $40 trillion, And the average American just doesn't really seem to have what it takes to retire. It takes a lot. And so we have to be building it right now by taking risks and doing things that are maybe outside your comfort zone. I don't know. The stock market to me is risky when I can't touch it or have no effect, or when I'm not the one making the decision about what asset my IRA actually holds. Maybe I can, hold mutual funds, but who's making the decisions about that mutual fund? I like assets where I'm making the decisions. So you might feel that same way. That's a lot like what note investing is. If you haven't heard about self-directed IRAs, or if your investors haven't heard about self-directed IRAs, they're not alone, because even still, a lot of people haven't even heard about this, even though the IRA, which has always been self-directed, started in 1975. Gerald Ford was president, and he signed the ERISA laws into effect. That's the Employment Retirement Income Security Act. So for nearly 50 years, you've been able to invest in anything except life insurance and collectibles. So, if you didn't know about it, don't feel bad, because a lot of the top pros don't know about it. So what's the difference? An IRA is an IRA, and it's like a bucket that holds assets, and it holds them for retirement. And IRAs, whether they're self-directed or not, have certain rules. You can read about them on the IRS's website, irs.gov, super easy to find out. But a typical IRA is going to invest in stocks, bonds, and mutual funds, maybe a CD. Nothing too, exploratory there, nothing too adventurous. But a self-directed IRA is when we get adventurous, and it's pretty fun to invest in notes and to, performing and non-performing debt, as Jerry mentioned. Self-storage, commercial, what do we have? People invest in all kinds of different things, even farms. Although when you invest in something that's a business, it takes us off on another tangent. But here's a list of some of the alternative assets that self-directed IRA investors can invest in. So it just gives you more control over the asset. So I did mention or alluded to that the IRS did have these limits. Well, they're just so simple. The limits are that your IRA can invest in anything except life insurance contracts, collectibles. Now, a lot of life insurance contracts already have tax protection, the proceeds do. And collectibles are not considered good assets for a self-directed IRA in general, like no artwork or no cars or, coin collection. You can invest in precious metals, but the level of purity has to be super high, like 9.99999% fine. So not even Krugerrands fit that level of fineness. And if you want to talk about, we can go further into depth on investing in coins, but the numismatic, the collectible coins aren't allowed. So no life insurance contracts, no collectibles, but everything else is allowed in an IRA, okay? And of course, there are some rules. So it's super important to go over the rules because these can be deceptively simple. Basically, you want to keep things arm's length from disallowed people, right? That's the number one way to avoid getting in trouble with your IRA. So borrowing money from the IRA, you're not allowed to have personal benefit from the IRA today. An IRA is 100% for retirement benefits for later, not for now. You don't sell an asset you already own to the plan, because that would be your IRA, buying, that would not be arm's length, would it, if your IRA bought an asset you already own? It's not security for a loan. Now, you might be getting a mortgage and you have to put your retirement account on that 1003 there. And if that's the case, they're just trying to see what kind of assets you hold in general. But you don't use an IRA or a solo 401k to buy anything for personal use. It's all arm's length. It's all for later. Okay, so that's a good rule of thumb. So prohibited transactions, keep away. So neither you nor any disqualified person, and that's your ascendants, parents and grandparents, you and your spouse and your children, so your descendants. Plus, a 50-50 business partner would be disallowed. And any fiduciary to the transaction would also be disallowed, like maybe a lawyer or a CPA or even a realtor might be a fiduciary to the transaction. They would be considered a disallowed party. So you want to keep arm's length from having the deal be involved with one of those people. So your IRA doesn't buy, sell, or exchange assets between itself, the plan, and a disqualified person. So what that means is your IRA doesn't buy an asset you already own. Your IRA doesn't sell an asset, maybe say to your kids. Your IRA wouldn't make a loan to your spouse so they could start a business. You definitely want to keep IRA money arm's length from disallowed people. It's pretty easy. But this last bullet point here is saying that the disallowed person can't provide goods, services, or facilities to the plan. This is where we really see a lot of mistakes. So a disallowed person, for example, maybe your IRA is investing in, say, a multifamily property, and so maybe you bought a fourplex, which is that multifamily. I think it's still, say, fiveplex, okay, a multifamily property, and that's you. But maybe your husband has a property management company. Well, your husband is disallowed, so his property management company could not manage the units that your IRA owns. That would be a prohibited transaction. So if one of these things occurs, a prohibited transaction, you can't really unring that bell. You can try to correct it. And so you can definitely try to make corrections and discuss it. But if the IRA sees that you've done this and it really goes deep, then it's game over for the IRA, and it blows that tax protected bubble of the IRA or the solo 401k. And that means fees and fines and things. But in my 17 years experience in this industry, I've personally only run into maybe half a dozen real prohibited transactions where something really bad happened. I mean, and so just know that we offer, by the way, a 30-minute consultation. So if you want to, I'm going to put this in the chat. If you want to reach out to us and say, hey, look, I've got this deal that I'm looking to put into a self-directed IRA. Does this meet the criteria? Is it a prohibited transaction? Does this seem suitable for an IRA? We'll have that chat with you and talk to you about, maybe other things you might want to consider or, where it stands. So you're not on your own, although you are 100% responsible for not committing a prohibited transaction. We can't really keep you from it, although we will try. So with self-directed IRAs and just retirement in general, it's a reward for saving and investing. And if you don't do it, well, then not saving and investing is a punishment. So Just keep that in mind. We all want to be ready for retirement, and that's what UDirect IRA services. And there we go. So let's see. Let me add this, by the way, to the entire group. So I'm going to put this here. And this is how you reach us to contact. And retirement, it's a multi-layered thing. So there are many different layers. And one of the layers to the self-directed IRA is that an IRA can actually borrow money. Coming from a residential lending background, I was super surprised to learn that a bank would actually make a loan to a retirement account, but it will. It's sort of like a commercial loan. It's a non-recourse loan. And so basically the IRA takes on this debt. And if the IRA were to default on the loan, the lender can only come against subject property, not against you personally, not against any other assets that are in the plan. So that's nice. That's the non-recourse part. But it definitely does come against the subject property. No personal guarantee, of course, because you can't provide services to the plan. So not a lot of these non-recourse lenders to choose from, but I do offer a list. So if you would like a list of non-recourse lenders, not necessarily a list of people we endorse, but a list for your convenience, just shoot me an email, info@udirectira.com, the letter U, udirectira.com. Be happy to send that list of non-recourse lenders. But these lenders are going to ask for a higher down payment than you would have if you were buying a property personally. They're going to want like 40, 50, 60% of IRA money in the deal, and then they'll lend the balance. And of course, you're not going to, again, personally guarantee the loan. When your IRA does borrow money, it can lead to taxes. And this always surprises people because isn't an IRA tax-free or tax-deferred? Well, it is. It's income tax-free and tax-deferred. But these are two different kinds of taxes, UBIT and UDFI. So UBIT, we don't see a lot, the unrelated business income tax that comes into effect when someone does run a business in their IRA, because it just really is so cost prohibitive. The tax is high and you really don't see a return. But the UDFI tax is a tax that comes up when your IRA invests in an asset and proceeds are earned because of debt. So when this is the case, your IRA files a 990T, your tax person can do this, but you can take deductions. So you may not even owe any tax, but you just want to file that 990T. So we don't offer tax advice. We can chat about it a little bit here, but to find, really the nitty gritty of it, talk to your tax advisor or go to the IRS's website, irs.gov, and look up publication 598. And then you can read all about these twin taxes. When an IRA owns an asset like a house or a note, any expense of that asset has to be paid for by the IRA. So we're talking about notes today. So maybe you've got a note and the borrower isn't paying, so you want to maybe foreclose on that property, and your IRA would take possession of the property. Then your IRA, the asset would change from a note to a house. But if there were expenses involved, you could never pay those expenses personally. That would result in a prohibited transaction, so you don't do that. So if your IRA does run out of money, how do you make up that shortfall, right? So I always get asked that question. So I have this slide to explain that there are lots of ways. I mean, you could make a contribution, and that of course depends upon your age, your account type, and your income actually, because you could make too much to contribute. You could liquidate other assets in the IRA, and that could help you make up that shortfall. You could transfer assets from another IRA or 401k, just move them on over and make up the shortfall that way. Or bring on a partner, like a debt partner, or take on a loan. But if the IRA cannot make up the shortfall of expenses on an IRA-owned asset, then the solution is really just to sell that asset. So that's how you deal with that. So buying real estate with an IRA, we're going to talk about that here, but this is really just the same as getting any other asset in an IRA. First, you open the account, then you fund it, then you invest. So you get that account open, shop for your deal, be it performing or not performing debt. Even if it's metals, you're going to find a metals dealer who can sell this to you. Whatever it is, find your asset. Remember, the IRA is the investor, not you personally. So the asset is vested in the name of the IRA. And we review that. You give us the contract. You give us a direction of investment letter, which is basically something like a check. It's your permission to disperse the money. You give us that, we review it to see if it's administratively feasible for us. Assuming that it is, you disperse the money, and then all proceeds go back in the IRA that own that asset. Any expenses of that IRA are paid by the IRA that owns the asset from IRA funds. And there you go. So when it's a recorded note, like a secured note, or when it's real estate, you're going to fund and record, and then that IRA is going to be the owner on title. And any rents or any loan payments are made to the IRA. And by the way, this is what is one of the most common mistakes? It is somebody making a payment to the IRA holder instead of the IRA account. If you're an IRA holder, you have an investment in your account, someone makes that check payable to you, never ever cash it. That is a prohibited transaction. What you do is return it and say, please make the check payable this way to my IRA account. And that way you can avoid a prohibited transaction. Now here is something, this is a tool of the IRA, the self-directed IRA. It's not a gift with purchase. That's a common misunderstanding. A lot of people think if they open a self-directed IRA, they get what's called a checkbook IRA. It doesn't happen that way. But you can, as a self-directed investor, have a third party create a special purpose LLC. Your IRA can buy 100% of the initial units of that LLC. Then your IRA funds the LLC, puts money into it, and that will go into the checking account of that newly formed LLC. And then you, as the IRA holder, can write checks and invest directly from that IRA-owned LLC. So the IRA is the umbrella. There could be a solo 401k, whatever the account, but that's the umbrella. And then the LLC is an asset of that account. It's under the umbrella. And why would you want to do this? Don't just do it because someone told you. I mean, do it because there's a real reason. For example, if you want to go to an auction and you want to buy properties at auction, they're not going to wait a couple of days for you to get a check and bring it back. They're going to want the money right then. And so the IRA-owned LLC, the checkbook IRA, can be super, super helpful. A lot of people will invest in private equity using an IRA-owned LLC. Now, I don't know if you need an LLC to invest in an LLC. That's your decision, but it might be overkill. If you live in the great state of California, the IRA-owned LLC costs you $800 per year, plus whatever you pay the attorney to set it up. So it's very expensive in California, as are a lot of other things. So just check before you do this and decide if this makes sense for you. But hey, it's an option. A lot of self-directed IRA companies don't allow it. We do. So it's another tool in your toolbox for your retirement. To answer a frequently asked question, it's not just the IRA that is self-directed. And just here's a picture of what it is. We just call it a self-directed IRA as a general term, but it's the traditional, the Roth, SEP, simple spousal inherited IRA. It's also a solo 401k, which is a 401k for an individual business owner who has no full-time employees in any of the businesses they own. Okay, but it's really cool investment tool. It's got lots of bells and whistles. And other plans too, like the HSA, you can self-direct a health savings plan as long as you have what's called an HDHP, a high deductible health plan where you work. So all of these retirement account types are self-directed. Now, what if you have money right now in a 401k or a 457 or a 403b and it's with your current employer? Chances are you can't move that money until you leave the service of them. That's good to know because you don't want to get all the way into a deal and realize, I can't even access that money. But if you have a 401k, you can go to the employer's plan administrator and say, hey, find out if that plan has what's called an in-service transfer. Because if it does have the in-service transfer, you've got a chance of getting that money out and self-directing. So that's what you have to do. Now, this is the same whether it's your IRA and you're looking to invest, or if you have investors and they want to invest with you, definitely ask them where their retirement funds are today so that you know whether or not they truly have access to that money to self-direct and invest with. Now, it's important to talk about, fair game here about losses. What happens when your IRA loses money? Sometimes deals don't go the way you hope. Not the majority of the time, but it does happen. So you want to do your due diligence up front as much as you possibly can. And then in the deal, continue to do your due diligence. Don't stop just because you invested. Continue to check under the hood to make sure that everything's running. You might want to ask up front for financials. You want to be in touch with the people that you've given your money to. It's hard earned. It's not easy to save, like say, $50,000, $100,000 to give to someone. So make sure that you're checking on that deal and make sure they know you're checking on it too. It will definitely help along the line. But when there is a loss, they call it black swans when things happen you don't expect, maybe It could be like rates go up through the roof or something like this, and there's something that happens and you lose money. Those losses cannot be written off in a self-directed IRA or any IRA, just not, you don't write them off. So know this in advance, that due diligence really is your safeguard and the best thing you can do to protect your IRA investments. So how do you do this? It's 1, 2, 3. It's open, fund, invest. Open an account, super easy. You go to our website, start an account. We have a digital application. 10 minutes later, at the most, you have an account. Then you have access to the account online. And you can start the process of step 2, which is funding the account, either by contributing, by transferring an existing IRA, or by rolling over a previous employer plan. These are the ways you can move the money. So it's open, it's funded. Now you invest. And you give us a copy of the supporting documentation. That would be the contract for the asset. You give us a direction of investments, your permission to move the money. And then once we get all these things, boom, we will send your money out as you direct. You know, good name for a company, right? It says you direct. And then now your IRA, now you've self-directed. And all those proceeds go back in the IRA that owns the asset and in the expenses of that asset. Like, for example, in private equity right now, a lot, because rates have changed, and it changed dramatically when it changed, there's a lot of capital calls. And so people are being asked to bring in capital in syndication deals. That money has to come from the IRA. That's an example. So just know that that money comes from your IRA. And there you go. You open, fund, invest, and that is how you self-direct. If you'd like to get a hold of me, this is how to do it. You can send me an email, info@udirectira.com, or shoot me an email there, or just go on our website, udirectira.com. And we have the answers to all your self-directed IRA questions. We have a very robust blog. So anything you can think of, I think I've covered it. And if you have a topic I haven't covered in the blog, let me know and we will cover that topic to make sure that we have all the answers. So Jerry, that is a quick overview of self-directed accounts and what the rules are and how to use them. But if anybody has a question about their particular situation, I'd be very happy to take that question.
Absolutely. That is awesome information. I appreciate you going through and telling us that. I just want to tell everybody, look, this is separate from what Ms. Hall said, and I have a very biased point of view because I am directly involved in note investing. So let me separate what I'm saying from what she said and be very clear about this. She provides services as a directed IRA investment professional. I will just tell you that combining those two, I think, is an absolutely amazing opportunity. That's why I wanted to present you with this. I don't know of any better way in this current market that you can engage with either performing or non-performing notes and arrive at above average returns that are very well secured by real estate. And I definitely encourage you that if you do decide to go ahead and talk with me and schedule another follow-up, and by the way, Ms. Hall and I both have links in the chat there where you can schedule 30-minute talks with her for custodian services and with us. Sorry, let me just mute that one individual. There we go. And I'll just tell you that that's my favorite way to recommend that people invest is through their self-directed IRA with FiveWB. I will tell you, Ms. Hall talked about due diligence. That's what our next conversation will be about. I've encouraged you to go ahead and schedule a time to continue conversation. That's exactly what we're going to do, as it should be. We're going to talk about due diligence, what each one of those paths looks like, some more specifics about both performing and non-performing. So I invite you to make use of the links that both Ms. Hall and myself have offered to you to follow up with us. Told you we'd give a little bit of time for some Q&A. You can ask a question directed to Ms. Hall or myself. If you've got a question, go right ahead. We'll spend a few minutes answering questions.
And Jerry, I'd like to also let everyone know that we do have a free report on our website so that you can learn more about, about note investing as well as other, alternative asset types. And so that is a quick overview of the self-directed IRA process.
Absolutely. We do the same thing. Everybody loves a good free report, right? So, it's a way for folks that wanna kick the tires and check things out before you dive in and have a full-blown meeting with us. That's awesome. I recommend you get Ms. Hall's report and ours as well at FiveWB. If you have a question, go ahead and jump right in, speak up and let us know. We'll answer a few questions for a few moments. About either one. You can ask Ms. Hall a question about self-directed IRAs, or you can ask me about FiveWB, performing or non-performing questions. If you've got, maybe we just answered all the questions, Ms. Hall. I don't know. It was that informative. But if you have
I'm sure we did.
I guess that's it. I guess that's it. We'll wait another moment or two because I promised that we'd have a Q&A. If you'd like to ask a question, you can throw it in the chat or just speak out and let us know.
We're always here for people who have questions to ask us offline too, because sometimes people don't like to, they don't want to talk about their personal situation or something like that. But just know that we're always here. Oh, here we do have a question from Barry.
All right. Does one invest in a fund of notes or an individual note? Great question. Now, with us, which that's what we're talking about tonight, is FiveWB. It would be in an individual note, okay? So we are not, FiveWB is not a pool or a fund, to be very clear about that. So the answer to your question very specifically is you would be investing directly in a note attached to one property. And that's part of what we'll go into when we're talking about due diligence, when we have a 30-minute private conversation, should you decide to go ahead and do that. But that's the answer to your question. You ask in the second part of that, if we help, if there's a problem. Now, this is where we provide real value, is that we are actually involved with that transaction with you for the entirety of your investment. Okay, we do not package these. There are groups out there that do this. I'm not saying whether this is good, bad, whatever. I'm not trying to put anybody down. But we're not putting you into an investment and then selling that investment off and just washing our hands, okay? We're not only figuratively, but we're literally still invested with you in that transaction for perpetuity until that loan either refis or it is taken elsewhere in the market, you decide to sell it, right? So we would be with you for the entirety of that time, Barry, and it would be one note, one property. Hope that answers your question. Other questions? I'll wrap us up here in just a minute if we don't have more questions, Ms. Hall, but thank you. That was actually very helpful. I think that you have a great service. I have looked at a considerable number of providers. I think that your business provides a great service. I really appreciate you taking the time to explain what you do to everyone.
Yeah, thank you so much. And I really appreciate the opportunity to be here. I love talking about self-directed IRAs. And by the way, I think Barry had an additional little addition to his.
He does. He wants to know if he can get out in less than 30 years. The short answer is yes. Okay. So you can. The fact, I understand what you're getting at here, with a fund, you can sell your shares, that sort of thing. So I will just tell you in general, yes, we can get you out of that. We typically have, and we work with people on an individualized personal basis, Barry. We can structure this so that you're, involved or committed, if you will, for between 3 and 5 years. Okay. I'll be glad to tell you exactly how we do that and how we structure those arrangements. But the short answer is no, sir. If you get involved in a note with us that has 28 years left, you're not obligated to stay in for the full 28 years. And we'll be glad to show you how that works. Okay. But great question. If you didn't ask, you wouldn't know. So great question. Does anyone else have a question before we wrap up this evening? I enjoy the questions. Hey, that's great. I appreciate it. If someone else has one, or Barry, if you've got another one, have at it. You've had great questions. All right, I think that everyone is ready to go eat, Ms. Hall. I think that must be what it is. Everyone's ready to head out and get a bite to eat. Thank you so much, Jerry Wallace with FiveWB. I greatly appreciate your time. My guest here has been Ms. Hall with UDirect. Great self-directed IRA services. I encourage you to spend some time looking at what she has to offer as well. I am Jerry Wallace signing off for tonight's webinar. Thank you so much for your time. Please get in touch. I look forward to speaking to each one of you in the days to come. Have a great evening.
Thanks,